Hello everyone, I am Rahul sir, your management educator. Today I am here. As you know that yesterday we started the crash course on our most important topics of management. Here we are covering the unit 458. Today we are discussing the most important topic of financial management, that is capital budgeting. This topic is damn sure a question is asked every time from in your exam. So before starting, there is an important information for you that the UGC NET exam is very close now. It's most probably is going to happen in the June. To boost up your preparation, we are providing the paper UGC NET Management Paper 2 course. If you take this course, you will get complete video lectures, full test series, PYQ PDFs, and this is going to be a target based preparation. The most beneficial advantage is paper 2 course. If you take the paper 2 course, you will get paper 1 totally free. The fees of this course is 7,000 rupees only. And remember that one thing I would like to tell you, the test series is most beneficial because it is seen that in our previous exam that some questions came as it is had come as it is from this series. Okay, then for this you have to download our global online official global online app. This is after logging in, you will see the home interface. In case click on the store button and click on the UGC NET paper 2 management. If you after paying, you can get the freely access with n number of times by clicking on the respective folder. Here we have provided all the content. To join the batch or to if you have any queries about the batch, you can contact on the given number. Okay, let's start. In today's lecture, we are going to cover the following things. What is capital budgeting? What is the nature of the capital budgeting? Process of capital budgeting and capital budgeting techniques. This is 1000% sure topic. Every time NTA asks question from this topic. So after watching this video complete, you will have no doubt regarding this topic. This is my guarantee. Point 1. Let's understand what is capital budgeting. Capital budgeting is the process of making investment decision in the long-term assets. It is the process of deciding whether or not to invest in a particular project. All the investment possibilities may not be rewarding. What happens? Generally, capital budgeting is subjected to, first thing you should remember that it is related to investment decision. Three elements we had discussed: FDI, so it is subjected to investment decision. Then what type of investment? Long-term investment. And later on here the projects are evaluated by using multiple techniques, and because we have to select the best one, whichever project is best for us, we have to select one, because all the opportunities which we are getting will not give, it is not necessary that all will be beneficial. Anyone or any one of this which will give an optimum benefit to us will be this opportunity we have to select, for which we use the capital budgeting concept. Okay, so let's understand some examples. At what time we will use capital budgeting. So if you have to do day-to-day operations expenses, you will not use capital budgeting. Capital budgeting is used for long-term projects, large which requires huge investment. So here the first point is expansion of business in other geographical area. Suppose here a business is located in the Mumbai and you have to open a new branch in Amravati district. So here what you will do, you will plan a capital budget to do that, how much investment is required, what location should be there, everything you will plan and invest your money according to for expanding your business from Mumbai to Amravati. Then replacement of an obsolete equipment. Obsolete equipment is which is damaged to some extent. It is not getting properly utilized and giving the optimum output which it should give. So at that time we will replace such equipment, and this is at this time because the equipments are very costly, so we need to use capital budgeting. Then new product or market development. If you have to develop any new product, add any innovative feature in that product, then at this time you will plan or develop a market for your product. At this time you will use the capital budgeting. Then research and development. This is a common thing that in research and development regarding any any field of the management or marketing or operations, anything. So we have to do research which requires huge money. So at that time we will use capital budgeting. And re-engineering, whenever you want to completely renovation of your business, at that time you will use capital budgeting. So these were the examples where capital budgeting is utilized. Now let's understand the nature of capital budgeting. Nature of capital budgeting, it involves high cost. As you know, as I told earlier, capital budgeting will be used for high cost projects only. Then this is a high, there is a high risk in capital budgeting decision, and the expected return is high. It's the principle of finance that wherever the risk is high, the return will also be high. So in case of capital budgeting, because we are investing a large amount of funds, so there is risk, but this risk will also give return. Then it is used only in case of long-term projects and long profit estimation. Capital budget, remember this, if you find any statement in the exam that it is used for both long-term and short-term, that statement will be totally incorrect, because it will be used in case of long-term projects only. Then it is considered the application of funds. Here what you are doing, you are not procuring funds, you are not financing, you are utilizing the funds. Then therefore this point is mentioned that it is used as application of funds. Then capital budgeting decisions are irreversible. Suppose in case a person marries a girl, then later on, after a few years, he find that they are not ready to adjust with each other, they will take divorce. But in case of capital budgeting, the decision which you had taken is irreversible. Once you invested, you lost. So you have to the capital budgeting decisions are irreversible. You have to take them very cautiously. It was joke, don't ignore. Pay attention. Then it is a complex in nature. Capital budgeting is very complex in nature, as so many as a huge risk and huge investment in nature. After long meetings and all that, this decision is finalized. Then it is based on the principle of sunk cost. Sunk cost means what? The cost which you have once paid cannot be recovered. So this is the principle of sunk cost. Okay. Let's see. Process of capital budgeting. What are the steps are involved in the capital budgeting process? Let's see. Project identification. First we will see the projects I try to identify. Then evaluation. In this step, in the case of evaluation, we will use multiple different techniques like payback period, average rate of return, net internal rate of return, net present value. So all these techniques will be utilized before selection of the project. Then project will be selected. After, suppose here it is different projects like A, B, C, D. Here what we will do, we will identify, as we identified these ABCDs, then here we are applying the capital budgeting techniques, that NPV. Remember one thing, if one technique is used, is fixed, that this we have to use to evaluate the product. In each project, same technique will be applied. As this should not happen that in project A you are applying NPV, then in project B we are applying profitability index, then in project C we are applying payback period. Such things should not happen. A common technique is used for all the projects. Then only it will give you the reliable results. Then project selection. After selection, after evaluation, you get to know that the project B is giving the best return, so you will select the project B. Then project B will be implementation, that is project implementation, and project performance and review. Whatever the project, how the investment you are in, performance and review of the project you will take after an investment. Okay. So that was all about the process of capital budgeting. Let's see capital budgeting techniques. Capital budgeting techniques are methods to evaluate an investment proposal in order to help the company to decide upon the desirability of such a proposal. means how much a proposal is desirable to company, how much it will give benefits. So for this, certain techniques are called, methods are used. These methods are used are called capital budgeting techniques. I hope you understood. These are just what methods which are utilized to select the best proposal. Here the capital budgeting, the main factor is considered, that is time value of money. The classification, let's see the classification. The capital weighting techniques are mainly classified into two categories: traditional approach and modern techniques. Traditional techniques here involves the payback period and average rate of return, which is also called accounting rate of return. And in case of modern techniques, we have three techniques, that is net present value, internal rate of return, and profitability index. Okay, so here you, in case of modern technique, remember PIN, and here PA in case of traditional technique. This you can payback period and average rate of return, traditional technique, and this PIN. These are the modern techniques. Okay, so profitability index, internal rate of return, and net present value. So this was here a chart is mentioned. Here you can see all more effectively that traditional payback period and average rate of return, and in modern we have NPV, IRR, modified internal rate of return, the for future version of internal rate of return, and profitability index. I hope this is clear. Let's see the first technique, average rate of return. It is all average rate of return is also called as the accounting rate of return technique. The average rate of return techniques considers mainly the profit. If you asked in the exam, key both profit and loss will be considered, no, only profits, and that is not only profits, the average of the entire profits which the project earns in its future life, that all years profit will be considered, and their average will be the main aspect for evaluating the project. Okay, so it considers entire life of the project. Then it is relation between the average annual profits and investment. This this is average investment, I am writing in short, and divided by initial investment. This is the formula used to calculate the capital budgeting through ARR. ARR method formula, it's this. I have it in next slide also. Then it ignores time value of money. Time value of money is not considered in case of ARR. Then it involves accounting treatment. As the name suggests that accounting rate of return, this is the another name for this technique, average rate of return. So it involves some accounting treatment. Then next topic point is the net profit after tax and depreciation is considered while calculating the average rate of return. While calculating the average rate of return, suppose this is your EBIT, that is earning before interest and tax, where you find the profit. So this profit will not be considered. Here the interest will be reduced. Then you get EBIT, sorry. Then the tax will be paid, and after this you will get the EAT, exact earning after tax you will get, and the average will be taken of this EAT. Average EAT, remember this, key earning before interest and tax will not be considered as a whole profit for this. The after depreciation and taxes and interest, after payment of all these three things, the average profits will be calculated. Okay, then expressed in percentage. As the name suggests, it's a rate, then it will also always be expressed in terms of percentage. That's all for average rate of return. Let's see, in case of average rate of return, what will be the decision rule? What type of decision rule will be taken? If the ARR is greater than the cutoff rate, the project will be accepted, or else if the cutoff rate is less, if the ARR is less than the cutoff rate, the project will directly rejected. Okay, the formula for ARR is average profit into 100 divided by net investment. Okay, so always remember that the profit will be considered, that is earning after tax. Okay, suppose this is the EBIT, this DIT section will be totally reduced, and after that you will get EAT, earning after taxes. This will be the base for the profit for calculating the average profit. Okay. There are some steps involved in determining the payback period. Let's understand them. First of all, we will determine the what is the initial investment. Then after that we will determine what are the cash flows after tax in per year. Then determine the military frequency of the cash flow after tax. Then we will determine the frequency of the cash flow after tax. Later on, the next determine the year which exceeds the initial cash. If suppose your initial cash flow investment is 10 lakhs, and when in the suppose 4th or 5th year you get the money that is 11 lakhs, your total, the cumulative total becomes 11 lakh. This is the year you will determine, and after that you will take the decision to whether to accept or reject the project. Okay. Let's discuss the formula of payback period. That payback period is mainly two formulas are used. In case of constant cash flows, we will use the initial investment or the original cost of the assets divided by cash flow. And if the cash flows are not constant, they are even or uneven, that payback period is determined by using the formula year before the break even plus unrecovered amount divided by cash flow in previous year. I hope you understand the payback period technique. Payback period. Now let's discuss the net present value, most important, very frequently asked in exam. It is also known as net asset method. Remember this name, net present NPV is also called as NAV, that is net asset method. Then it is the modern method of capital betting. Now onwards modern methods are started because they are considering the time value of money. Then it is the discounted rate is considered for the computing the net present value. Here we consider a discounted cash flow, and is discounted rate is the discounted rate is the rate of return or the expected rate of return or present value factor. Here we consider the discounted rate has multiple names like present value factor, cost of capital they will give in the question, but now practical as not asked on this topic. Earlier it was asked. Then this is the best method for mutually exclusive project. Mutually exclusive projects simply means that one project will be accepted and at the same time another project will be rejected. Then it considers the entire life of project. NPV considers entire life of the project. It is used in case of even or uneven cash flow. Whether the cash flow is constant or not, NPV can easily be used. And the calculation in case of NPV is very complex because you have to see the multiply the cash flows through discounted factor, and again sum of all those cash flows in all year is subtracted from the initial investment. Okay, this will give NPV. So here if the NPV is positive, the project will be accepted. If the NPV is negative, the project will be rejected. And if the NPV is 0, the indifferent, we will consider some another factors. So formula to determine NPV is present value of cash inflow minus present value of cash outflow. Okay, the present value, the present value is calculated is equal, present value factor is equal to C upon 1 plus R raised to power n. Okay, I hope it's clear. Let's see the second last technique, profitability index. So profitability index is also called as time adjusted evaluation method. Remember this point, it can be asked by changing the name. So it is also called time adjusted evaluation method. It tells the value on 1 unit or 1 rupee. It is the most cheapest value because most beneficial method because you can get the value of the project in 1 rupee only. It is also called benefit cost ratio and considers the time value of money. Then modern method of capital betting. These are the points related to profitability index. Then what will be the decision rule? In case of profitability index, if the profitability index is greater than the 1, we will accept the project, and if the profitability index is less than 1, we will reject the project. The formula for determining the profitability index is present value of cash inflow divided by present value of cash outflow. Okay, the present value of inflow divided by cash outflow. This is the formula for calculating the profitability index. Then fifth technique comes internal rate of return. Internal rate of return is the modern methods, because it considers the time value of money. Then this is also known as the time adjusted rate of return. This is also called as time adjusted rate of return, yield method, trial and error method, and hit and run approach. These are all other names of the IRR method. Remember this. Then it is the rate where the NPV is 0, and IRR is the certain rate where the net present value and becomes 0, and here it is the rate at which the cash flows is inflow is equal to outflow. Okay, and considers the time value of money. This is points we are observing. So the rates are decided internally. The rates for finding the IRR are decided internally. So let me give you an example. Suppose we have two projects, and the given rate is 11% and 12%. So what we will do, we will calculate the value of same project on 11% and 12%, and then whichever is less we will consider it. Okay. Let's see the IRR decision rule. IRR, if expected rate is if internal rate of return is greater than the expected rate, we will accept the project, or if it is smaller than the expected rate, we will reject the project. Formula to calculate IRR is equal to RA plus NPV A upon NPV A minus NPV B bracket multiplied by RB minus RA. Here what are the things mentioned? Let's see. RA is the lower discount rate chosen, then RB is the highest discount rate chosen, and NA is the NPV at rate A, and NB is the NPV at rate B. Okay, I hope you might have understood. So this was about today's lecture. I hope you understood all the concepts of capital betting. Let's meet in next video. Then we will discuss the topic dividend theories. Okay, bye.